Welcome back to the channel. My name is Jeremy, and as many of you know, I am striving to be fired. No, I'm not trying to lose my job. Not yet, at least. I am trying to be financial independent, retire early with dividends, or FIRED. While the name is similar to the traditional concept of financial independence, retire early, there are some significant differences between the philosophy of each. In this video, I will discuss what financial independence, retire early, or FIRE is, how traditional FIRE works, and how pursuing FIRE with dividends is different, and provide my take on why I chose the dividend path instead of traditional FIRE. For the past few years, I've listened to a podcast and YouTube channel called Two Sides of FI, where the hosts are on a traditional FIRE journey. One of the hosts is recently FIRE and the other is a few years away. It is a great show and I highly recommend it for anyone with similar aspirations. A regular topic that is discussed on the show is regarding asset allocation and how and when to draw down each bucket of assets, like stocks, bonds, and cash. Each time I listen to one of these discussions, the only thing I can think about is how stressed over it they seem to be and how much thinking goes into making these decisions. It makes me reflect on my choice to focus on FIRE with dividends instead of the drawdown approach of traditional FIRE. FIRE is a movement that has gained momentum over the past decade and espouses the idea of saving and investing a large percentage of your income in order to accumulate enough assets that you can retire early. The movement is based on an academic study called the Trinity Study, which stated that an investor with a mix of stocks and bonds can safely withdraw 4% of their assets and then adjust each year for inflation, and not run out of money over a 30-year time period. Traditional FIRE uses this idea, and the goal is to accumulate the balance you need to pay for your expenses with that 4% withdrawal and never have to work again. Theoretically, with the market going up over time, your money should last your lifetime. So what can go wrong? Well, first, market crashes, especially at the beginning of your retirement, and also long periods of little investment growth. Just look at the decade of 2000 to 2010, where the market barely moved. These can derail your plan and you are at risk of running out of money. The other downside of traditional FIRE is that you are reliant on the market to cooperate. You are relying on millions of other investors to price your investments favorably and increase them over time. It is completely out of your control. FIRE with dividends is different in that you don't really care about the market returns or the principal balance since you're never going to use it. You'll be living on the dividends, not selling down the principal to live off of, and your principal will outlive you. Instead of drawing down your investments over time, you are just using the dividends. If your average dividend pays 4% and grows each year with inflation, you can still achieve financial independence, retire early, and you also get to maintain your investment balance. The accumulation phase of FIRE with dividends is not about accumulating total dollars, it is about accumulating future total income. You don't need to worry about stock and bond allocations, changing interest rates, market downturns affecting your drawdown. You also don't need to be worried about selling at the bottom because you had to pay your property tax or pay for some other big expense at the absolute worst time. Markets will go up and markets will go down, but a basket of quality dividend growth investments pays forever. And since you are not selling down the balance with FIRE with dividends, your asset allocation is not a problem. The solution is a diverse group of strong dividend payers, and that's it. Dividends are the cash flow you'll use to pay your expenses. The principal invested is just the payment for that future income, not your actual future income. Traditional allocation of a 60-40 stock-bond mix or other variations doesn't apply. Dividend payers, especially solid payers like dividend kings and dividend aristocrats, will continue to pay you through good and bad market cycles. Your future income is decided by the companies, not by the whims of the market. With traditional FIRE, you are selling assets. With FIRE with dividend, you are only using the cash flow from those assets. With traditional FIRE, you have nothing or very little left when you pass on, but dividends can last generations. While both paths can lead to financial independence, I find FIRE with dividends is an easier and more sustainable path and that fits my needs, desires, and risk tolerance. Thank you for watching. Please leave a comment and like below if you like this video, and go work your hardest to go get fired.